Every single day, over $20 trillion worth of stocks change hands across the world. Every single day. And most people, including most investors, have no idea how this system actually works. Not just what a stock is, but where this whole thing came from, why it was built, how it operates, and why it's the engine behind nearly every major fortune ever created. Today we go deep. The stock market didn't start on Wall Street. It started in Amsterdam. Over 400 years ago. In 1602, a Dutch trading company called the VOC, or the Dutch East India Company, had a problem. They wanted to send ships to Asia to trade spices, but the voyages were incredibly expensive and incredibly dangerous. Ships could sink, crews could die, pirates were real. The whole investment could disappear overnight. No single merchant could afford to take that risk alone. So the VOC did something revolutionary. They split the company into small pieces and invited the public to invest. Any Dutch citizen could buy in. No minimum amount, no maximum. A carpenter, a maid, a merchant, anyone. Over 1,100 investors put in nearly 6.5 million guilders. The world's first initial public offering was born. And when those investors wanted to sell their shares to someone else, a secondary market appeared. That secondary market became the Amsterdam Stock Exchange, the world's first stock exchange, in 1602. The idea spread across Europe. London built its own exchange. Paris followed. Then came America. By 1792, the United States was a brand new country. Alexander Hamilton, the first Secretary of the Treasury, had just issued $80 million in government bonds to pay off Revolutionary War debt. Brokers began trading those bonds on the streets of Lower Manhattan. But there were no rules, no structure, no trust. A speculator named William Dewar manipulated prices and triggered the first financial panic in American history. In response, 24 brokers met under a buttonwood tree on Wall Street on May 17, 1792. They signed a 2-sentence document. It said they would only trade with each other and charge fair, fixed commissions. That document was called the Buttonwood Agreement. It became the founding charter of the New York Stock Exchange. From 2 sentences under a tree to the largest stock exchange on Earth. Most people think the stock market is a place where prices just move randomly. It's not. There's a precise system behind it. Here's how it actually works. Step 1. A company goes public. When a company wants to raise money from the public, it does what the VOC did in 1602. It files with the SEC, the Securities and Exchange Commission, the government body that regulates markets. It splits itself into shares, and it sells those shares to the public through an IPO, an initial public offering. Step 2. The secondary market. After the IPO, those shares trade on exchanges like the NYSE or NASDAQ. This is what people mean by the stock market, not the IPO. The secondary market, where existing shareholders sell to new buyers. The company doesn't make money here. That money goes between investors. Step 3. Price discovery. Every second the market is open, buyers submit bid prices, the maximum they'll pay for a share. Sellers submit ask prices, the minimum they'll accept. When a bid meets an ask, a trade executes, automatically, in milliseconds. This constant process of matching bids and asks is called price discovery. It's how the market decides what a share is worth at any given moment. Step 4. Market hours. The U.S. market runs Monday through Friday, 9:30 a.m. to 4 p.m. Eastern Time. Outside those hours, prices don't change officially, but sentiment and news still builds, which is why stocks often open very differently from where they closed. Of course, an investor or trader can trade in stocks outside this timing, and it's called after-hours trading, which is done through electronic communication networks. I will not recommend that for beginners. And we will discuss about ECN in detail in another video. Here's something most finance videos never say. The stock market isn't just there for investors, it's infrastructure. For companies, it's how businesses raise the capital they need to grow, hire, research, and build. Without public markets, most of today's largest companies simply would not exist. For economies, countries with strong stock markets consistently generate more jobs, more innovation, and higher living standards than those without. The stock market is how a nation turns private savings into productive investment. For individuals, it's the most proven mechanism in history for regular people to build wealth over time. Historically, the U.S. stock market has returned about 10% per year on average over the long run. On a $10,000 investment held for 30 years at that average return, you'd end up with over $170,000. That's not a salary raise. That's not a side hustle. That's your money compounding silently while you sleep. Prices move because of one thing: the gap between expectations and reality. When a company's results beat what investors expected, price goes up. When reality disappoints expectations, price goes down. Beyond individual companies, three macro forces move the whole market. Interest rates. When the Federal Reserve raises rates, borrowing gets expensive for companies. Profits shrink, stocks fall. When rates fall, the opposite happens. Economic data. Jobs reports, GDP growth, inflation numbers. These tell the market whether the economy is expanding or contracting, and markets price that in immediately. Sentiment and fear. Markets are not perfectly rational. Human emotion, fear, greed, panic, euphoria can push prices far away from fundamentals, temporarily, but always temporarily. Now for the part most finance channels skip. The stock market has crashed, many times, badly. 1929, the Great Depression. Stocks lost nearly 90% of their value. 2008, the financial crisis. Markets fell over 50%. 2020, COVID. Markets dropped 34% in 33 days. Every single time, the market recovered and eventually hit new all-time highs. Every 20-year period in the S&P 500's history has ended in positive returns. Every single one. But when this matters, you only get those long-term returns if you don't panic and sell at the bottom. The biggest risk in the stock market isn't the market itself. It's your own behavior during a crash. 400 years ago, a Dutch trading company let ordinary citizens own a piece of global trade. Today, you can own a piece of Apple, Microsoft, or any company on Earth from your phone in under 5 minutes. The stock market is the greatest wealth-building tool ever created for regular people. Understanding it is the first step to using it. Next video, we cover index funds. The single, simplest way to invest in the market without picking individual stocks. It's what Warren Buffett recommends for everyday investors, and we'll tell you why. Subscribe so you don't miss it, and comment below, what's the one part of the stock market that always confused you? Tell me, I want to answer it.